So time value of money calculations, most people are familiar with. So I do that just to start you off to get you to remember the power of compounding. Most of the calculations that we're going to do in terms of rates of return are going to be based upon what are called asset return calculations. And the idea is we have some investment. Say, think of buying a stock. We buy the stock today at a given price. We hold it for some period of time, maybe 4 months and 7 days, and we sell it, and we want to know what's the rate of return on that investment, right? And so associated with that, we have something known as the holding period return. And then given a holding period return, we might want to slice and dice that holding period return to express it as an annualized rate of return or something like that. And so that's what we're going to do now in this part of the course. So again, the idea of a timeline is useful for asset return calculations. So the idea is today I have some asset I purchased for P0. So P0 is the price today of some asset. Okay. Now in this course, we're primarily going to be dealing with equity type assets. Stocks, mutual funds, exchange traded funds, things like that. So assets that are traded on exchanges, assets that we can get easy price information free from the internet, not have to pay some data subscriber and so on and so forth. We could be looking at futures contracts on commodities as another type of asset. Again, we can get information pretty easily available and so on. We typically won't be looking at assets like investing in foreign currency or fixed income assets, investing in particular bonds and things like that. The primary focus is really going to be on equity-oriented types of assets. So the easiest way to think about it is just investing in a stock. So here, P0 is the price today on some asset. Let's say that's Starbucks stock. Okay, and then at some time in the future, at time t, we're going to sell the asset for PT, right? And so this period between 0 and t is our holding period. Right? That's the period of time that we actually physically own this asset. We hold on to it. And at the end of the holding period, we sell it. And the rate of return, the percentage change in price over the holding period, is the holding period return. So the holding period return is equal to the price we sell it for at the end of the holding period minus the price we pay for it at the beginning of the holding period divided by the price we pay for it at the beginning of the holding period, right? This is just the percentage change in price over holding period. Okay, so when we talk about a holding period return, it's just percentage change in the price over a period of time that we hold the asset. Now, very often holding periods are some standardized period, like 1 month or 1 year, and so on. In principle, the holding period could be, 6 days, 7 hours, and 20 minutes, and 6 seconds, right? But for our purposes, we're going to consider pretty regular holding periods. Typically, 1 month is going to be our default holding period for analysis. Sometimes it'll be a day, sometimes it'll be a year, but we're not going to consider weird holding periods like 2.5 days or something like that. That's mostly just for convenience. And the homework problems, will deal with issues when you have irregular holding periods. How do you adjust some of the calculations and things like that? But from the point of view of the lectures, it's going to be pretty simple. So the default holding period for the notes and what's going to be going forward is going to be 1 month. All right? And so the notation is going to be P of T is going to be the price at the end of month T on an asset that doesn't pay any dividends. Okay, so think of a stock that doesn't pay a dividend. And P sub T is the price at the end of the month. P of T minus 1 is the price at the end of month T minus 1. Okay, so this is the price at March 35th. This is the price on February 29th. Okay. Then, so my holding period is 1 month, and so the monthly rate of return is just the percentage change in price over the 1 month holding period. And so RT is the 1 month return, percentage change in price over 1 month. Now we can write this percentage change in price, PT minus 1 divided by PT minus 1. That's equal to PT divided by PT minus 1 minus 1. So we can rearrange this holding period return to define the net return or gross return, define net and gross return. So RT is PT minus 1 divided by PT minus 1. And again, you want to think of your holding period from time T minus 1 to T, PT minus 1, PT. And the return with a time step T is the percentage change in price between T minus 1 and T. Now we can take this return and write it as PT divided by PT minus 1 minus PT minus 1 divided by PT minus 1, which is PT divided by PT minus 1 minus 1. So RT is equal to this, and then we can take this minus 1 to the other side and write RT, or 1 plus RT, is equal to PT divided by PT minus 1. So 1 plus the rate of return is called the gross return, and this is then just the ratio of prices. So you can also think of this as sort of like the future value of a dollar. If I have $1 invested at T minus 1, how much does that $1 grow after 1 month? It's equal to $1 plus the interest rate on $1, 1 plus RT. Okay. So now one of the things about this class that I want to emphasize, and that is to get an idea of what are reasonable orders of magnitude of rates of return on different investments. Okay. So if you hold Microsoft stock for a month, how much on average do you really expect to get on a 1 month investment in Microsoft? Is it 10%? Is that reasonable? Is it 1%? Is it 100%? And so when we start looking at data, you know, pay attention to the orders of magnitudes of things. And I think it's very important to have that in our mind. You know, what is a typical rate of return over a year on an investment in equity, right? What's a typical rate of return over a month, right? And so, so we'll illustrate this by example and also by looking at real data. So this is an example that's somewhat unrealistic. So we invest in Microsoft. Now, it might have been realistic if you were back in 1990 and investing in Microsoft. This might have happened, but it's not necessarily the case if you're investing in Microsoft now. So you initially buy Microsoft for $85 at the end of the previous month, and you hold it for 1 month, and the price goes up from $85 to $90. So you get a $5 increase in 1 month, right? So what's your monthly rate of return? Well, it's a percentage change in price over the month. And this gives us a rate of return of 5.88%. So that's a 1 month holding period, right? Now remember, right now if you invest in a U.S. government T-bill for 1 year, you get less than 1% for the year. This is illustrating getting 5% by investing in Microsoft over a month, right? Almost seems too good to be true, and so this is quite unusual as a monthly investment. And so your $1, your gross return, 1 plus the net rate of return is 1.05. So if you started with $1, then after 1 month you'd have $1.05 and 88 cents. So it gives you 5.88% per month. Okay. Now, let's look at multi-period returns. Let's say our horizon is not 1 month, but we have a 2-month investment horizon, right? What is the rate of return over a 2-month investment horizon? So now I use this notation R sub t parentheses 2. So this means I have a 2-month rate of return. That's what this notation means. What's the 2-month rate of return? Well, it's the percentage change in price over 2 months. So now the idea is I have my investment horizon. Here's t minus 2, t minus 1, and t. I buy it for pt minus 2. I sell it for pt. What is my percentage change in price? So over the whole period, I have a 2-period return. Okay? Percentage change in price. And then we can write this as pt divided by pt minus 2 minus 1. So 1 plus the 2-period return is the ratio of prices. Now, one can ask the question, what's the relationship between this 2-month return and the 2 1-month returns between t minus 2 and t, right? So I want to know, I have some return here, and I have another return here. And I have this 2-period return over the 2 whole periods. We can do this little trick. We know that the 2-period return is pt divided by pt minus 2 minus 1. Now, we can take this pt divided by pt minus 2, and we can multiply and divide by pt minus 1. That gives us pt divided by pt minus 1, pt minus 1 divided by pt minus 2. Now, pt divided by pt minus 1 is 1 plus the rate of return between periods t minus 1 and t. And pt minus 1 divided by pt minus 2 is 1 plus the rate of return between time periods t minus 2 and t minus 1. So notice that the 2-period return is, this is called a geometric average of 2 1-period returns, and then minus 1. So notice this 2-period return is not the sum of 2 1-period returns, but it's a multiplicative relationship. Okay. So the relationship here, this is then equal to 1 plus RT minus 1 times 1 plus RT minus 1. Now, this is what it is. But as we'll find from a modeling perspective, we're going to build probability models for asset returns. And one of the nice things about probability models that we would like to have is a nice relationship between asset returns, say, over 1 month and asset returns over 2 months or 1 year and things like that. And we would like to say things like asset returns are normally distributed. Now, when you start having relationships that are multiplicative, that makes it very difficult in modeling things, particularly with random variables. And so this multiplicative relationship between a 2-month return and the 1-month returns may cause some problems. And so I just want to point that out, that this is somewhat of an inconvenient relationship. All right. So to summarize, we have a 1-month gross return over month t, a 1-month gross return over month t minus 1, and the 2-month gross return is the product of the 2 1-month gross returns. Okay? And if you look at this relationship, so the 2-month return, when you multiply everything out here, so 1 plus RT, 1 plus RT minus 1, so you get 1, and then RT, and then, RT minus 1, then RT, and then RT times RT minus 1. The 1s cancel over here, so the 2-month return is the sum of the 2 1-month returns plus this cross-product term. And now if these cross-product term is small, then the 2-month return is approximately the sum of the 2 1-month returns. Okay? So it's almost additive, but not quite. And so again, that's one thing to keep in mind. So we can do an example here. Just plug in some data. 2-month return on Microsoft. So again, we buy Microsoft at 80 initially, and then we sell it at 90 over this 2-month period. So now, over 2 months, Microsoft stock goes up by $10 over 2 months. So we get a 2-month return of 12%. Okay, that's pretty darn good if you can get 12% over 2 months. And then what are the 2 1-month returns? So remember in our previous example, the price between in this month here at T-1 was 85. So our rate of return between T-1, between T-2 and T-1, we got 6.5% over the first month. And then over the second month, we got 5.88%. And so our 1 plus or 2-month return is the product of the 2 1-month gross returns. Everything works out fine. Okay. Now we can do the same thing if our investment horizon is K months. So say our investment horizon is 2 years, 24 months. And so what's the rate of return over 2 years? Well, it's a percentage change in price over 2 years. And so this would be the 2-year gross return. What's the relationship between the 2-year gross return and the 24 1-month returns? Well, it's this multiplicative relationship. This is called a geometric average. So the 24-month gross return is the product of all of these 24 1-month returns. And again, it's multiplicative. It's not additive. And so we don't have this relationship here because of all the cross-product terms. And as I said before, from the point of view of modeling asset returns, this multiplicative relationship here makes things a bit cumbersome. And so we'd like to see if we can get around this in some way.